Good morning. Welcome to Stock Market Today. It is Monday, October 19th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. I also give you daily stock ideas, or we give you daily stock ideas to consider. That hits your inbox every trading day before the market opens. So let's dig in. U.S. equities finished mixed on Friday, fading into the close. All but the Russell 2000 posted a third week of gains. On the day Friday at the sector level, utilities, healthcare, industrials, and materials were the outperformers. Tech, energy, and discretionary lagged the broader tape. Treasuries were unchanged to slightly weaker. The dollar was flat on the major crosses. Gold finished down 10 basis points. WTI crude settled down 20 basis points on Friday afternoon, and crude oil has really just been hanging around that 40 level, not really able to break free one way or the other. Now, as we get to the desk this morning, futures are bid. Renewed hopes of pre-election fiscal stimulus helping send the S&P futures up 90 basis points here on the first day of the week. Asian markets were higher overnight. Japan and Taiwan outperforming. China did end lower. European markets are solidly to the upside. Treasuries are mostly weaker, with the curve steepening, which makes sense if we have the prospects for stimulus earlier than anticipated. Dollar weaker on the major crosses, particularly against sterling. Gold up 40 basis points. WTI crude down 30 basis points, and that's the framework as we head into a Monday morning with the markets for all the news and the headlines. But the song remains the same, really. Majors are above key levels, right? All the news and headlines, but the song remains the same. What do I see here? I see the SPY above 340. That keeps you bullish, with odds favoring upside to the September highs. Qs are above 280. That keeps you bullish, with eyes towards the September highs. And IWM is above 160. That keeps you bullish, with eyes towards the highs from earlier this year, January, February timeframe, and all are within striking distance of 52-week highs. In the case of SPY and Qs, those would be all-time highs. Now, the highs for the IWM were actually back in 2018. So something just to keep in mind. But from a framework perspective, the bullish structure of the market remains in place. We can argue with why it remains in place. We can chat. We can go back and forth, thoughts, ideas. I think where it really comes down to is the prospects for stimulus remain there, regardless of who's in the White House, right? Stimulus regardless. The question is how big and when, as opposed to if, right? And a blue wave, in my opinion, increases the odds that a package or group of packages could actually be larger, which could potentially be bullish for the market. So just something to keep in mind going forward. A lot of moving parts here. We're going to check it out. Our market in a minute now. What are we writing about? Well, as we said, equities start the week within striking distance of the high. Stimulus remains a key driver along with earnings, right? Not lost, but interspersed with all of the macro, with the stimulus, with the election, with COVID and vaccine, it's still earnings season. Earnings season kicked off last week. The banks were a sell the news event. Remember, I was watching that closely. I was looking and see, not making a call, but to see if earnings were a catalyst for the banks. They weren't, not at least a bullish catalyst. Solid results, but they were sell the news event. Mark Chaikin does a good job of recapping this in his note that went to our clients yesterday. Treasuries are under pressure in the range. Commodities and the dollar await a catalyst. It's haven't gone anywhere. So maybe the election is the catalyst, maybe the inauguration. I don't know. But we can see it playing out in the marketplace right now. It's solid, do nothing from a trend perspective. Are kind of stuck in these ranges, waiting a catalyst. So futures point to a higher open today, as we said. Taking a look at the major indices now, the Dow was up 37 basis points, 4-3 bulls to bears. Remember, that had been even for the past few days, so we skirt to the bulls. S&P 500 down 5 bips, call it flat. Let's not split hairs here. 135 to 67 bulls to bears there. NASDAQ down 50 basis points or 55 basis points, was an underperformer. 29 to 7 bulls to bears. Small cap slight underperformer as well. 770 to 240. Bonds down tick. Utes go higher. Interesting. I've been watching the utilities closely, and I'm still trying to figure out if it's defensive positioning I don't think it is in this case. I think what we're seeing is low yields in treasuries. I think we're seeing yield plays in the equity market away from utilities come under pressure. So maybe this is a source of stable yield in investors' minds in a low rate world where treasuries are under pressure. I don't know. But utilities were your leading sector on Friday, up 1.07%, 42 bulls to bears there. So just something I'm watching closely. Our stock of the day, PerkinElmer is interesting to me because there's not a lot of names that are leaders and oversold. So when I see them here in the near term, I mean, remember the markets are overbought. We've been writing about it. We've been talking about it. They're starting to alleviate some of those overbought conditions. But with that, obviously, the strongest names are likely overbought as well. But here's in a situation where I see PerkinElmer, right, which is in the life science tools and services area of healthcare, which is a bright spot within healthcare. That's kind of the med tech side of the equation. The industry is strong, has a very bullish rating, is strong trend above the rising long-term trend line. So we have a very bullish stock outperforming. Money flow has been predominantly bullish for the past 12 months, and it's not at, but it is nearing an oversold condition. So I take a look at that and I say to myself, well, that's an interesting opportunity within the healthcare space, which has been mixed from a relative standpoint, but med tech has been a bright spot. So I see this as an opportunity here, PKI, within the next few days. Work, even it may get more oversold, right? Or it may bounce here, but I think you have a kind of a clear picture that you could shoot against here. Support in the 110 to 120 range, right? And you're kind of playing for that. What I see is a breakout retest and potential for a rally. So PKI looks really interesting to me as a long idea. It's in my note. It's on the show here for you. Let's take a look at our sector tracker now, movement of the major sectors over the last 5 days of trading. Industrials at the top of the list. That's pretty interesting, as that's one of the cyclical groups that we have liked. So that's playing out. It's nice to see. There's your utilities in the number 2 slot. That's the one that's somewhat baffling to me. I'm not quite sure what to make of it yet. I've been mulling it in my head for a couple of days, and I've kind of settled out on it's probably not defensive positioning because people are concerned about equity. It's just like I can't get there given the breadth dynamics, given the small cap breakout, the small cap relative strength, right? And some semis, I can't get there. Like I could be wrong, but I think it's a low probability event. Comms, tech, and staples round out the groups that are higher over the last week of trading. Lower over the last week is trading, middle of the road, discretionary materials and healthcare, and lagging financials, industry, energy, and real estate. As financials, I was looking for the bank's earnings to be a catalyst to the upside, potential upside, but it didn't plan out, right? I've been watching them, right? And saying to myself, look, this downtrend, this relative downtrend in financials appears to be losing momentum to the downside. Maybe the banks can be a catalyst. And if the banks happen to be a catalyst, I would have had conviction to become more constructive on financials as a sector and banks in general, but it just didn't play out. We'll take a look at the regionals in a little while. REITs are interesting to me as well. The fact that they remain under pressure, I think that those are more of a COVID play at this point, or a lot of them are COVID play. Let's take a look at our industry in focus. Speaking of banks, regional bank services, big laggard over the past 6 months by 19 and a quarter. However, that power bar ratio, which looks at future potential, is very strong. 65 to 11 bulls to bears, currently ranked number 6 of 21 subsectors, having moved up 1 slot over the past week. So if you're looking for ideas in the banks, obviously it makes sense to be selective. Hilltop, Hancock, and First Commonwealth are all very bullish here at Chaikin Analytics, but are all holdings in a fund that looks like this, right? It looks very similar to the bank ETF that we looked at last week. Neutral rating, okay. Strong trend, sure, it's above the trend line, which is flat, right? Very clear that the trend since the March lows is flat. Underperforming, severely bearish money flow, massively overbought. So I just can't get there. The catalyst that I was looking for in bank earnings hasn't played out yet. Now it's still early in earnings season, and we heard from the majors. Maybe the regional banks have something different to say. So I'll continue to watch this. I can't get there. I want to get there. Believe me, I want to get there. Because if we saw the banks get in gear, at the very least, that would be another breath positive for the market. Let's take a look at what's trending now. Friday's movers and shakers are gainers and losers. General Electric didn't see anything really company specific to drive that stock higher by 6%. Pfizer, some commentary on vaccine, up 3.8%. ALK, that's Alaska Air, October passenger revenue update. To me, it looked like a situation of just being less bad than feared, or better than feared, because the numbers were horrendous, but obviously the market was looking for worst. WestRock, nothing company specific there. That stock's been strong of late. WRK up 3.3%. And LH got some reimbursement clarity as it related to testing around COVID. Investors like what they heard there. They took the stock higher by 3.3% on the day. JB Hunt, JBHT, a little bit of a disappointment because the transports have been strong and the truckers have been part of that. And JB Hunt, JBHT, their earnings disappointed, and stock got hit hard for it, as it should. 9.73% to the downside. Schlumberger earnings down 8.8% as the energy sector, another one. A lot of smart people looking at energy, seeing the sentiment being washed out, doing the work. I myself, the argument is convincing enough to me that I've sought out some information and we'll spend some time reading it and being up to speed. It's interesting enough to me. The folks who are calling for a bottom in energy are making a compelling enough case for me to pay attention. Now, obviously, I'm not going to do anything until the trend changes. I'm a trend follower first and foremost. But the argument is compelling enough to me to warrant additional attention, so I'm going to, but it's not there yet, clearly. I mean, Schlumberger's earnings were a mess, and Halliburton goes along for the ride, and Halliburton reports today, actually. That stock was down 6.25% on Friday. Devon down 5%, Oxy down close to 5%, so there's your energy complex. Nothing company specific on either of those names. Let's take a look at the charts now. Let's dig in. On Mondays, we look across asset classes. No conversation across asset classes would be complete without gold. And I've said it before and I'll say it again. I am long-term trend perspective bullish on gold. I am near-term a shoulder shrug on gold, the commodity, because of this break down from the consolidation, right? What I saw was a massive uptrend that went into a consolidation, and I was playing for the consolidation to resolve to the upside. Thus far, it hasn't. It actually resolved to the downside and has become choppy once again. So to me, what I'm starting to say is, okay, within this near-term choppiness, there are probably better uses of my capital, right? There's an opportunity cost to sitting in gold while it does nothing. But where do I want to get involved? Okay, where are the levels in both directions? This is the conversation I'm having with myself in my head. Thankfully, not out loud. My wife would walk by the door and think something was wrong. Maybe sometimes I have it out loud though. What I'm looking at on gold here is this 1800 level. Now, this is not original. Everybody can see that that's a key level. So realistically, we may not get there and we have to be prepared for that. Really, it's 18 to 1825 that would get me intrigued. Should we leg lower? Now, what if we don't leg lower? Remember, I'm constructive on gold long-term trend perspective. So I don't want to get too cute because it didn't get down to 1825 and miss it. So what I'm looking at here is about 1950 to the upside. A break of 1950 to the upside would get me constructive again in the near term to align with my longer term trend perspective view. So that's how I'm framing up gold. And what I do find interesting is that during the consolidation, we have not become oversold, and the miners have actually held the breakout level. So that's all encouraging. I do like the miners as an option on gold as well. Let's take a look at the 10-year. 10-year yield is does have a little bit of an upside bias to it, doesn't it? Double bottom with a bullish divergence back in August, and now an upside bias. The question is, have we broken out? Hard for me to make the case that we've broken out. Probably watching about 90 basis points here. 90 basis points lines up. Well, 87 basis points is the 200-day moving average. 90 basis points is around this level here. I think if we break 90 basis points, you have to say to yourself, we're going higher. We're probably going to 1.5%, probably going back to this level right here. So it's something to keep in mind. What that means for broader markets, we'll have to watch. But obviously, with the prospects for stimulus, that could be a catalyst for rates to move higher. And the dollar, I gave you the we're waiting because there it is. I mean, RSI in the middle of the range, dollar just kind of chopping around, holding the 50-day, still below broken support, still below a declining 200-day. This is arguably the most important chart in the market right now, and it's it's not giving us much to work with. So we'll continue to watch it and see how it plays out. That's going to wrap us up for today. Happy Monday, everyone. I hope everybody had a great weekend. Take us for a test drive if you haven't already. I'll be back tomorrow.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.